see us. All right. Yep. Technical troubles. Okay. Welcome everybody with audio. In today's show, we are going to show you how to slash your taxes and deal with the incredible inflation that is such a problem for contractors all over America. Welcome to this new channel, Field Service Live. I'm your host, James Leichter. If you've been with us for a few moments, you saw we had some problems. That's why we are keeping this in the lowdown. We didn't do a lot of advertising and marketing because we never knew what would happen. But apparently YouTube, I guess, thought we were on a different time zone or something. I'm not sure what happened, but we got that figured out. Crack engineering team got it all figured out. We are a channel dedicated to the field services industry. And that would be any company that goes out in the field and works on commercial property, residential property, homes, buildings, industry, and does maintenance, service work, installation work. So that might be a heating, air conditioning company, plumbing company, electrical, appliance, commercial refrigeration. Pretty much anyone that drives a vehicle, goes out and fixes things. That's the field service industry, and it's a great industry to be in. That's my background. That's what I've done for a long time. Great industry to be in right now. We've had some tough times, as you know, lately. Good or bad, our industry has benefited from it immensely. And this channel is dedicated to helping those types of companies. Now, tonight, we're going to talk about taxes, accounting. One thing about taxes is you can't avoid taxes. You're either trying to avoid them or you're paying them. And there's no other option, right? There's an old saying, it is legal to avoid taxes. It is illegal to evade taxes. You got to pay your taxes. But there are a lot of legal ways to reduce your income taxes, and we're going to be talking about that in tonight's show. So with that, I'm going to introduce my awesome guest. He is a CPA. His name is Mark Schlemmer. He is with the RA Tax and Accounting firm. And what is your official title out there?
I'm the Managing Shareholder of the Tax Division.
Tax division. All right, so we got the tax guy here, and he forgot his pocket protector. I don't see a pocket protector, mechanical pencil, right? What kind of CPA doesn't have a pocket protector and a mechanical pencil? I don't know. I do know he's a great CPA because he is my CPA, and I asked him to be on tonight's show, and he said, oh my gosh, I'm not a speaker. I don't like to speak. I like computers and spreadsheets. And I said, it's okay to be a nerd. We won't judge you here.
Thank you.
All right. I mean, I can't even figure out how to get streaming live with audio. So it can't get any worse than me, right?
I think we got it now. Hopefully.
Yeah, I think we do. All right. What I did is I asked some of my clients that I work with, some of the people that I do business with, to give me some questions to get started. I said, hey, I'm going to be doing this show. What are some questions you would like me to address? And that was my backup plan if we couldn't get people to ask their own questions. So I asked you this earlier, but there was no audio, and unless people were like reading our lips, they have no idea what the answer was. I wanted to go over a few things people can do with only 2 weeks left in the year to significantly reduce their income taxes. And what did you tell us?
Yeah, that's a great point. We've been doing planning for the last 4 weeks, and there is still time. But basically, we do financial analysis given income statement and balance sheet as of today. And then we have a discussion with the business owner about their business needs. One of the big tools in the toolbox we use for this service industry is business equipment and vehicles. If you feel like you're going to need something in the near future anyways, it's probably a good idea to go ahead and pull the trigger and get that equipment you need before the end of the year.
Okay, like maybe a new van, new truck?
Yes.
Okay. So let's say you have a truck that's it's $50,000 to buy the truck and outfit the truck. Nowadays, they're even more expensive than they were just 12 months ago. But let's say it's $50,000 because I'm not great at math, and that's a round number. If you if you don't pay cash for the $50,000 vehicle, you only have like $5,000 to put down. Do you get to deduct $50,000 or the $5,000?
Yes, the whole $50,000 is yours. You'll be able to elect to take bonus on the whole amount, even if you financed your vehicle.
So you could take $5,000 and create a $50,000 tax deduction.
Yes.
You could, in fact, if they say to you, how much money would you like to put down on this, James? My answer is always nothing, as little as possible.
If you have great credit and can get a great rate, I'd say do that.
Because as we were mentioning without audio, 2 or 3% is free money. I mean, if they'll loan you 2 or 3%, that's free to a business owner who looks at their return on equity, which is always 20, 30%, something like that. When someone wants to loan you 2 or 3% to put to work to make 30, it's free money, right? So let me say that again. You look at your financials and look at your return on equity. That's everything you got minus everything you owe is your equity. Correct me if I get any of this wrong, right?
Yeah, that sounds about right.
That's your equity. And you look at your net profit. So if you have $100,000 in equity and $50,000 in net profit, then you've got a 50% return on equity. And somebody wants to give you 2% to put into your business, that leaves 48%.
Yes.
Right? And the interest is tax deductible to boot.
Absolutely.
So you've got free money that costs you a little bit anyway, and even that little bit is tax deductible.
Right. And the beauty of financial planning before the end of the year, as we were talking about earlier with no audio, is that we don't have to make the election to deduct the full vehicle cost yet. We can wait until we file the tax return because tax planning, especially for a lot of our clients, happens at the individual level because they own pass-through entities. So basically, we're trying to establish a projected net profit, the projected QBI deduction. We're moving that information onto their individual return, and then we're doing what-if analysis. What if we just take regular depreciation? Is that a comfortable tax bill, or is there any tax bill at all? Do we need that bonus to bring you down into a lower bracket?
QBI, tell us what that stands for.
That's the Qualified Business Income Deduction. It was passed under the TCJA, and it goes hand in hand with the reduced corporate tax rate that went down to 21%. And so the lawmakers did not want everyone converting to a C Corp.
Okay.
So what they did was they allowed this Qualified Business Income Deduction for pass-through entities so that the average taxpayer would be paying tax on 80% of their profit.
Okay.
And it works out roughly to about 21%.
All right. I'm watching for these acronyms, everyone. I'm going to make sure that we get definitions of these. So you said a C Corp, and there's other corporations, right? What's another common corporation?
The S Corp is the dominant one we do business with, yeah.
So what's the difference between a C Corp and an S Corp?
C Corps are basically taxed at the entity level. There's no pass-through income. C Corps are going to pay tax right there on their return. They're not going to create K-1s for their shareholders and get taxed at the individual rate. They're just going to pay a straight 21% on their net profits.
A C Corp, as I understand it, is basically like a citizen of the United States with all the same rights except the right to vote, and they pay taxes. They, being the C Corp, pays taxes just like a person would. Mm-hmm. And that rate is 23%?
21%.
21%. Okay.
Plus your state rate. And if you get a dividend, you're going to get taxed on that.
Okay. So if I'm a C Corp owner and I pay myself a dividend, just like maybe Walmart might pay a dividend, I could pay a dividend to the shareholders, which I'm one of them. I pay a dividend, and that dividend, I could pay taxes on it like I would any other dividend. Is that right?
Yes. That is one downside of the C Corp is that there is double taxation. And if you are a C Corp, you generally have to keep your retained earnings at $250,000 or less. So you will be basically forced to distribute retained earnings in the form of a dividend to your shareholders.
Okay.
Unless you can find or have a business plan that addresses needs down the road, then you might be able to get above 250,000.
I see. That's something you want to talk to your accountant about.
Yeah.
Okay.
We only do a handful of C Corps here, but we've had a couple that we've had to tell them to go ahead and pay some distributions. Dividends.
Okay. All right. And then we mentioned the S Corp being passed through. So as I understand it, with an S Corp, when an S Corp makes $1, the owners made $1. It all flows into the owner's taxes.
Yes.
Okay.
Yes. Well, when the S Corp makes $1, if you're a 100% shareholder, then you've made $1. If you're a 50% shareholder, then you've made 50 cents.
50 cents.
The beauty of the QBI is that's going to be reduced down to 40 cents.
Okay.
Because you're going to get a corresponding QBI deduction with that profit.
40 cents. That's a little more than we made this year in my company, but we're a not-for-profit organization, but that's only because we're poorly managed.
Well, who manages that place?
Well, I do.
Okay.
But yeah, I think I should run a charity.
Yeah, I'll convert you to a 501c3 this year.
All right.
I'm pretty sure everyone will fork over some contributions.
Hopefully, Mom, Dad, they're up in the kitchen. Hopefully, they'll contribute some money. All right. So we talked a little bit about corporate structure. I think really what I want to repeat is, if you have any money to spend, now's a good time to spend it, because if you spend it this year, it becomes a tax deduction come April 15, but you can decide if you want to deduct all of it or part of it at that time. Is that correct?
Exactly.
And maybe deduct the rest of it some other year.
Right. You could go with 5 or 7 year depreciation life, depending on what it is you purchase.
Okay.
So you don't have to deduct the whole $50,000 this year. It's just an option. And that was part of the TCJA, the Tax Cuts and Jobs Act, because they were trying to spur economic growth.
Okay. All right. Very good. Okay. Well, that's helpful. All right. Hopefully everyone found that helpful. On a related note, how do you know if you have a good accountant? You mentioned talking to your clients, working with your clients. How do you know when you may need a different accountant?
If you don't hear from your accountant, actually, I'm still in this from James. He's going to elaborate on this, but actually, I love your answer that you gave me earlier, because we were talking about this. I'm like, I really don't know until you look at the financials and find out the mistakes. But you had another take, which I think is very true, and it falls under the umbrella of staying engaged, being a planner, and being looking at the future. So I believe you said something about, if your accountant is not bothering you throughout the year and asking you tough probing questions, then you probably have just a one-time tax preparer.
That's right.
Yeah.
That's right. I like to say it like this. I like to say your accountant should be like a doctor or a lawyer or a therapist. They should ask you questions that make you a little uncomfortable. They should ask you questions where you say, is that any of their business? And they should ask these questions before the end of the year, because if your accountant only contacts you at the end of the year to talk about your taxes, then you don't have an accountant. You have a, say it with me,
tax preparer.
Tax preparer. And most companies just have a tax preparer. And at RA Tax and Accounting, you really try to encourage people to work with you before the end of the year, during the year.
Absolutely. The planning is so essential to economic success in a company. And this year, I've just been able to see it. When you see that you're saving a company $15,000, $20,000 in federal tax, $6,000, $7,000 in state tax, that you see in the return off of planning. If that same client had not gotten a hold of me till March or April, those options are off the table.
Yeah.
So, we like to stay engaged throughout the year. I recommend quarterly, but a lot of our business owners they're not passive in what they're doing. They're very active. They're out there in the field. But if you can get in a couple of times a year and just kind of get a financial checkup, that should go a long way.
Okay. Well, I see it all the time, Mark. these companies miss out on all these opportunities because they don't talk to their accountant and they don't know about things that they could be doing, most of which are really easy to do. I'll give you an example. How many business owners get a call from their accountant, their CPA, and they say something like, happy birthday, you're a year older, but what this means is you can now put more money into your 401k, you can put more money into your IRA, which slashes your taxes. If you haven't gotten a call, if you're as old as I am and you haven't gotten a call like that, you've got a tax preparer. You don't have an accountant.
Exactly.
Right? So what are those rules, by the way? How old do you have to be to put a little extra money into those retirement accounts?
50. If you're 50, you can, the max contribution is $19,500 for a standard 401k. But if you're 50 or above, you can add $6,000 on top of that.
$6,000.
I believe that's this year's. I'd almost have to check the.
So we'll say it's $6,000.
I will tell you this: I would go with the lesser amount if I could get my joints back from when I was in my 30s.
Yeah,
I would.
I would like that. Yeah. So when you turn 50, so I have another 15 years or so before I can do that. Oh, yeah. Right. So, I wish. So think about that. 6,000. Let's say it is 6,000. If you put $6,000 into it and you're paying 40% taxes, federal, state, FICA, Social Security, all those things, you might be at 40%. Then you're saving yourself 40% of the 6,000, right? That's $2,400. You're saving $2,400 on your taxes and giving yourself $6,000. The only catch is you don't get to use that money till you're a little older, but it's your money.
Exactly. I like to tell people, pay your future self today and have that money invest for down the road, and then you're going to save your current self on taxes. So the younger you, today you can save on taxes, and you're paying your future self, and you're going to need it, right?
You're going to need it. So. You know, a lot of us don't think we're going to live that long. I didn't think I'd make it past my 20s.
Yeah.
But here I am. I'm old and thinking about retirement. So it happens to almost all of us anyway.
Yes, and it does take more than the average person realizes to get from a decent retirement age to, unfortunately, the end of life. So you want a pretty sizable amount saved up.
So you could buy the $50,000 vehicle, or it could be an 8-foot brake or a Pittsburgh Seamer or all those things. You buy a $50,000 vehicle, you put $0 down or $5,000 down, you've created maybe a $20,000 tax deduction. You put an extra $6,000 into your 401k, and that creates maybe a $2,000 deduction, $2,400 in this case. And that's your money. It's your money. You're being paid $2,400 basically to put money away for yourself.
Exactly.
Right?
Yep.
So people should be doing all those things, and it's the accountant that helps them with it.
Yeah. So, you know, after we analyze the business profits, it doesn't stop there. A good planner will carry that information onto the individual return and look at all the factors, and everyone has a different situation. But you know, a good planner is going to see and look at all sources of credit carryovers, capital loss carryovers, passive activity losses that are unused. We're going to pay attention to AGI limits for all kinds of different items, and then we're going to try to find that sweet spot where we can tell you, hey, if we can just do this much more, this is how much it's going to save you. And going back to the business, we look at accounts receivable, we look at accounts payable, we try to get an understanding of what kind of things we can do based on your, whether your cash basis or accrual basis for tax purposes. And accelerating deductions into this year, delaying receivables into next year. These are just a few more tools that can just drive that current tax rate down.
You said accounts receivable. Let's say somebody doesn't pay us, or we don't think they're going to pay us. Could we go ahead and just call that bad debt and take that as a deduction? How does that work?
If your accrual basis for tax purposes, yes, you just take the deduction. If your cash basis for tax purposes, You don't really see the deduction, but it goes into the formula that goes into your accrual, a cash to cash adjustment.
Okay.
So it's kind of in the background. But yeah, if someone doesn't pay a bill, you're gonna get some relief from that.
And what if they pay you next year, pay you all of it or some of it next year? Then what happens?
Again, going back to whether you're cash basis or accrual basis, if you can tell them, hey, write that check in January, and we're in a cash basis environment, then we're not going to recognize that income until 2022.
Not everybody knows what cash basis is and accrual basis is. What is the difference between those two things?
Well, cash basis, pretty much money has got to be exchanged for an expense to happen or for revenue to happen. Accrual basis, it just needs to be generated in the form of maybe an accounts receivable and accounts payable, and reasonably estimated to be collected in 30 to 60 days.
Okay.
And in that case, you recognize the revenue the day you generate the invoice or you make that purchase order to buy something.
Okay. One thing I want to talk about right now, all of you watching, and now we are actually listening too. They can hear us, which is like a bonus.
That's kind of scary. Actually.
Yeah. Well, the cord was unplugged or something. So I want to talk about cash versus accrual. Let your CPA decide if you are going to file your taxes under the accrual method or the cash method. But you as a business manager, owner, you do not run your company with cash reports. It drives me nuts when I hear people, in my day job, I run a software company. We make accounting software, and people will sometimes ask me, does your accounting software do cash basis? And I say, oh, God, no, absolutely not. Oh, well, we'll have to look at something else because QuickBooks lets you do cash reporting. Well, you're crazy to run your company using cash basis financial reports. Just because you manage your company under the accrual method of accounting, which is GAAP compliant, that's the only method that's GAAP compliant, not cash. You run your company with accrual reports, and you can file under cash. It doesn't make any difference.
Yeah, that's the most common thing we see is accrual basis financials that we then take onto the tax return, and they're cash basis for tax purposes.
I've had people say to me, oh, well, my accountant doesn't want me to switch software if it doesn't do cash accounting because we're a cash company. We do cash accounting. And I tell them, I think what you mean is you file under cash. And if you do, your accountant couldn't care less if your software is producing accrual reports because it takes about 2 minutes to convert an accrual balance sheet and income statement, right?
Exactly.
2 minutes, maybe.
An accrual basis balance sheet is just going to give you a more accurate picture of everything that's going on.
Very, very much more accurate. In fact, let me paint the picture for you. If you have a cash report, your income statement's wrong, your balance sheet's wrong, your job costing reports are wrong. That's because you did not make any money until you were paid and the money went into your bank account. It's not enough that you got paid and you have a check sitting here on the table. It has to be in your bank account also. So imagine doing all this work and your financial report, your income statement shows no income until the check comes and gets put in the bank. That's ludicrous. And all your expenses, you had none. Not until that check clears your bank. So you could go out and buy $1 million worth of parts and materials and equipment and have no expense. Not until your bank statement shows the money is gone will you have an expense. So obviously your job costing reports are all wrong, right?
Yep.
You have no inventory because there is no inventory in your company. It's all considered cost of goods sold when the check clears. You don't run a company like that, right?
No, we don't recommend that.
No, that's nuts. People do that a lot. But that's what this channel's about. No judging. Did I seem angry about that? Did I seem mad?
No.
I didn't want to come across as angry.
You're a concerned citizen.
Yeah. I didn't want to come across as angry.
It's a cruel world.
Not on the first.
See that? Accrual?
That's CPA humor, right?
Right. I just popped out.
And you said you weren't a good public speaker.
I'm horrible.
Yeah, well, he's got funny jokes. That's a tax joke. I mean, anybody that's into accounting should love that joke. It's a cruel world.
Yes. Get on board with accrual.
Yeah, yeah. So anyway, run your company on accrual. Let your tax people worry about cash basis or accrual basis.
Yeah, and let me just touch on this. No matter what you are on the tax return, whether you're cash basis or accrual, both bases are going to present options for you as far as planning and doing what you need to do to maybe drive down that net profit at the end of the year.
Yeah, I think that's a good point, and that's why it's so important to have meetings with your financial consultant, and that's what you are, right? To have meetings where you make that decision. You know, you decide, okay, this is the year that we're going to start filing under accrual or under cash or whatever.
Absolutely. Well, yeah, and that is a process, and it can be done every 5 years. But yeah, you file a 3115, and you can basically apply for a change of method.
Okay.
Tax return.
Okay. You have to have permission, don't you?
Pretty much, yeah.
Yeah. But they don't say no a lot unless you abuse it.
No, right, exactly.
Okay. All right. So there's the lesson on cash and accrual. I think that's a good one. I've thrown around the word accountant, CPAs. So all CPAs are accountants, but not all accountants are CPAs. What's the advantage of a CPA?
The advantage from a client perspective?
Yeah,
a little higher level of assurance. We're licensed. We've had to sit for the CPA exam. We usually have at least 150 credit hours. There's usually an experience factor involved before you can actually practice with a license. And then there's the continuing education aspect where, basically you have to meet those continuing education requirements to continue using your permit.
Okay.
Practice. So there's a level of assurance.
Yeah, I think I agree with all that. I think the advantage is that a CPA is potentially more educated. There's the ongoing education that's a requirement.
Yes.
And then you have the threat of losing your license, which keeps you honest.
Yeah, and I will say the last couple of years, the CPEs have been invaluable with all the changes in the tax law. The last 3 years in particular, I've just, every webinar, every conference I've been to, all the classes really helped me and my staff get through the tax season because there were so many changes. I would say last year was probably the craziest tax season we've seen.
Yeah, it was. So CPAs need the CPEs. What's the CPE stand for?
Continuing professional education.
Okay, all right. I told you I'd be on the lookout for those acronyms, defining those.
That's right, because actually I use acronyms so much I forget what the words actually
I know.
mean.
Yeah, I know. I do too. There's a lot of acronyms that I use as well, and I forget what they stand for. But then I don't have people like me asking,
Right.
What's that stand for? So, all right. So we talked about equipment. Also, I think that one thing you can do if you're a business owner is pay all the bills you can possibly pay. Make sure you get all your bills in. Pay all the bills you can possibly pay, depending on if you're cash or accrual. But one thing's for sure, get all those bills in, because if you're accrual, you just have to get the bill entered.
Just create the just create the purchase order.
Yeah. So
as long
get
as
those.
it's accounts payable, that will help you.
Mhm.
So.
Yep. And if you're a cash basis, it doesn't matter if you enter the bill, because you got to write the check.
You got to write the check.
Does it have to clear the bank on an income tax return?
I would usually, if it's in your financial accounting system, I will usually go with that.
Okay.
So,
all right, that's what I understand. It doesn't have to clear the bank. So yeah, you got to write that
if
check.
the check has been written and it's in transit, yeah, I would say it's a deduction.
Okay. All right. So on accrual, whatever you put on a charge card, on a credit card, that's deductible. But on a cash basis, it isn't.
Yeah, that credit cards are kind of they're month to month. The bill doesn't become due till maybe January 20th. They usually don't have a nice clean month end date. So what do we do with those charges that we made in December, but the actual credit card bill is not due till January 20th?
Mm-hmm.
I can tell you that if it's reasonable that you're going to pay that bill, gosh, I hope
no one's watching this.
Yeah. Usually that's not something we'll adjust out of your deductions because that's just going to be a timing difference. So if you take it this year, that's not going to be there next year, and that train will just keep rolling on.
Okay.
So,
All right. Okay. Well, another question that came to me that I wanted to ask if we had time is the work opportunity tax credit. I was asked about that. What is it, and who would qualify that? I don't know if that's your area.
I actually got a few family members that would qualify for that.
Oh, do you?
So, yeah, it's a federal tax credit program that's basically aimed at helping targeted workers, disabled vets, ex-felons. That's where my family members come into play. So it's a heavily compliant program. So, I mean, if you are going to partake in this, you really want to make sure you're doing it right. I have not done one myself, but I have known businesses that have used it.
Okay. All right. So I think that's something that everybody
Yes.
should look into. Basically,
Credits.
I guess it's money that you get back as long as you hire certain people.
Yes, and credits can generate incredible savings.
Yeah, so let's talk about that. We didn't say deduction or deductible something or other. We said credit, right? What's a credit? What's the difference?
That's going to be a dollar for dollar in your pocket. So a deduction, basically, we're taking that off of gross income, and then we're getting a tax rate. Credit just applies dollar for dollar.
Dollar for dollar.
Yeah.
So you paid them $1, you don't pay $1 in taxes.
Exactly.
So in other words, I'll say it a little better. If you pay someone $1 under this program, then you will save $1.
Yes.
The dollar's not deductible; it comes right out of your taxes.
Exactly.
It's great. Really, it's a great thing.
Yeah. There are some great state tax credits. We have some clients that take advantage of the angel investor credit in Kansas. That basically, if you're unfamiliar with that program, you can invest in startup companies and get a credit of $25,000.
Wow.
So, and you become basically an investor. So there's potential upside there as well if the company succeeds. If it goes under, you're going to get 50% for every dollar you invested in the form of a credit.
I wanted to ask also about the COVID stimulus money that many companies have been getting. Maybe one of your companies got some money under the various COVID programs. There's a forgiveness. Let's say a company has been forgiven, so the government said, keep it, it's yours.
Mm-hmm.
And this for many companies, this could be hundreds of thousands of dollars. How do you account for that in your financials? You don't call it income, because I guess it'd make your income look higher and you pay more taxes. So what do you do with that money so that you can account for it, but it doesn't show up as taxable income?
That's a great question. Now, the PPP, when you talk to CPAs, our circle is basically calling this the trifecta of bonuses, because sometime late in 2020, Congress decided to not only forgive the PPP loan, but they've decided to allow the deductions. So there's two of the three of the trifecta. The entry was pretty simple. You actually just get the loan off your balance sheet by taking it into tax-exempt income.
Okay.
Which basically ends up running through equity. The trifecta was that for a lot of our pass-through companies, partnerships and S-corps, it was a basis booster.
Yeah.
So if your basis was suffering from a few down years and you got a nice sizable PPP loan, you got the loan forgiven, so it wasn't taxable income. You got to take the deductions that you use those funds for, and then you go to your basis statement and you see this big, huge number, so you've got a basis booster. So it just covered all three.
Yeah, so you get $100,000. It's handed to you. It's not income, so it's $100,000 in your pocket,
Mm-hmm.
and then you spend the $100,000, and you get $100,000 in deductions. So you get 100,000, no strings attached, and you spend it, and there's 100,000 in expenses.
Yeah.
Reducing your taxes, maybe by 40%. So the 100,000 could mean 140,000 to you if you spent all of it.
Yes.
Right?
Yeah, and remember, it was the Paycheck Protection Program, so you need to be paying it for the right things, and I think we all know what that was. Retaining employees, rent, utilities, things of that nature. But yeah, if you met the requirements, it was forgiven.
Yeah.
And for a lot of loans that were under 150,000, the forgiveness process was pretty much non-existent.
Yeah, it just happened.
There was a couple of clicks, and that was it.
Voila, it was done. Yeah. See, that's another thing that benefits companies from having a good CPA, a good accountant, a good financial advisor. That is, they'll call and say, "Hey, Mark, this is James. Are you familiar with the PPE? Well, we got to get you that." Mm-hmm. And then call you later and say, "Are you familiar with the forgiveness? Well, we got to get you forgiven." And Mark, you're getting old. You can put more money into 401k. You should be getting these calls.
Yes.
If you're not getting phone calls like that, you have a tax preparer. You don't have an accountant.
Exactly. I never even got to reach out to people on the PPP because it hit the news, and our email and phone went off the hook. And so we spent a lot of time helping people through that process, getting the loans. And then, of course, then the forgiveness comes around and they get an email from the SBA or whatever bank they went through. And then all of a sudden they're contacting us again, help us through the process. And it was a lot of, it was very rewarding helping our clients through all that.
So I want to say something about banks. And I think this is an important lesson that I learned. I never really thought about what I'm about to say until PPE thing came along. I have a great relationship with our bank. I do have an online bank account, but I don't do much with it. But I have a great relationship with our bank. And when we did the PPP thing, we were treated like rock stars. I mean, the bank helped us put things through faster, took care of us first, because we have a long relationship with the bank, borrowing money from them and so forth. But imagine if all my money was in, say, Ally, an online bank account. Who would you call there? I mean, would they call me and mention PPP? No, I don't think so. Yeah. I mean, Ally, you're welcome to chime in on this, but I don't think they would. At least with my clients, the people that I know, and a lot of my friends are business owners, if they had online banking relationships only, then they found it a very difficult road to go down.
I would find that a lot of our clients, I thought the banks did a tremendous job getting them through the process and giving them the information they need to get them through that process. Mm-hmm. So, but yeah, I did hear some horror stories.
Yeah. I did too. Yeah, and a lot of angry people because they had a hard time getting it done. Their applications got lost or didn't get filed, and then you have other people that had great relationships with their bank and they were treated better and got it done.
Well, you think about just from the moment it was first passed and all the infrastructure that had to take place to get these banks lined up to wire this money. And, overall, I thought the banks did a pretty good job. Overall, I thought the banks
check my phone here, and I have I'm watching our on live. I'm going to look for, and I have I'm watching our on live. I'm getting some feedback, engineer. I'm getting some feedback, engineer. Let's see. Looking for these questions. A company offers a 401k or an IRA investment option. Is there any instance where I wouldn't want to do the IRA and pay my taxes now versus when I retire?
Got some heavy delay.
Yeah. See if I can fix that. Did you get that question?
It's one of those things where you're looking at today's tax rates, projected tax rates down the road. Some people choose to use after-tax dollars today and go with a traditional IRA or maybe a Roth.
It's down.
And that basically you're going to go ahead and a traditional IRA today will get you a deduction today, but you're going to have to pay tax down the road. But a Roth, basically you're going to pay the tax today, but if you meet all the requirements, the 5-year holding period and the age requirement, you're going to be able to pull that out in retirement completely tax-free, regardless of how much it earns.
I see. Okay. Well, I'll have our engineer, Colin, keep an eye out for the questions.
Susan has a question about, she asked, my company offers a 401k or IRA investment option. Is there any instance where I wouldn't want to do the IRA and pay my taxes now versus when I retire?
What do you think?
Yeah, I think that's the one I just answered.
So, I think that's
all we have right now. Question.
okay.
Oh, okay.
All right, very good. Just want to make sure we're watching out for those. We talked about buying a truck earlier. One question that I get a lot is, should I buy it or lease it? Do you have any opinions on that?
Well, every business has different circumstances. I think if you're looking at a passenger vehicle that's under 6,000 pounds, there's no right or wrong answer. Leasing is perfectly good there. I can tell you that if you are in this industry and a lot of your vehicles are over 6,000 pounds, going with the purchase is going to give you some more planning opportunities.
Okay.
Bonus does not exist in the world of leases, bonus depreciation.
Okay.
Whereas if you're purchasing a lot of equipment, you're going to have that option.
Okay.
So
I take it a lease payment is a tax deductible event.
Yes.
But when you buy it, it could be, doesn't have to be, you've got options.
Yeah, you can take it all, or you can take it over 7 years, and all the maintenance and fuel and everything it takes to run that thing will be deductible as well.
By the way, I remind people that there is a lot more profit for the seller when they lease the vehicle to you. Otherwise, why would they bother? Why would they lease a vehicle to you? So that you're going to pay more, in my opinion, for a leased vehicle. And on a related note, make a long story short, I could prove this mathematically, but I'm asked a lot of times about buying new versus used, and let's forget COVID for a minute, pretend like that dynamic doesn't exist. It's cheaper to buy new. It's cheaper to buy a new vehicle and have that vehicle be a reliable vehicle for a number of years rather than a used one where you're taking a chance that it may not start, it may need a repair. But I've owned a lot of vehicles, and I believe that it's cheaper to buy a new vehicle than it is to buy a used one. Buy it new, run it to death, get rid of it.
There you go. Okay.
You can always sell a truck.
Plus, you're starting with a higher basis for depreciation.
Yeah.
So, because new vehicles cost more. So
Right. So let's talk about that a little bit. A higher basis of depreciation. So I think what you mean is when you have a used vehicle, your depreciation, is relatively small because it's based on what you paid for it, right?
Well, if you're looking at a 2021, I don't know, what's a good service van in this industry?
Say a Ford F-150.
Okay, what is that, 60,000? Where if you went and tried to buy a 2015 or 2012 F-150, you might get it for 30,000? So
We'll talk pre-COVID days, yes.
Yeah. Okay, so you're starting out with a much lesser number, but again, it's about your company's needs, what you're comfortable with. But obviously, buying a $60,000 vehicle is going to give you a big chunk if you decide to take the bonus depreciation.
Okay. And again, these are all planning things. You plan these out with your CPA. You sit down with your accountant, CPA, financial advisor, and you think about all this stuff, and you plan it out, and it becomes part of your budget. And part of your budgeting is also a cash flow projection. So you know if you have money to spend on these things.
Exactly.
If you have money, you can spend money and create deductions that a poor person who didn't have any money wouldn't be able to take advantage of.
Exactly.
Right? All through planning.
Yeah.
I said this earlier, and I think it was when we were having audio problems. I have met quite a few wealthy people, self-made. I mean, inheriting doesn't count, right? You can be an idiot and inherit a bunch of money. But self-made rich people are usually not any different than you or me or anyone I know. It's just that they have these, what I call 2%ers. They do 2% better here, 2% better there. They pay 2% less. They get 2% more. They're 2% more accurate. You name it. Just little things that really add up. And all the things we've talked about just in this short period of time are things they already do and have been doing for years. And that's how their wealth accumulates, right?
Exactly. And I see it with some of these people, the ones that are engaged throughout the year and go through planning, usually are going to save that 2% and even much more in a lot of cases.
A lot more.
Yeah. So, I mean, it's interesting. One of the clients that I worked with saved, I think I already mentioned, over 20 grand in between federal and state taxes. And one of his questions was, as we were looking at the projections and discussing, he wanted to know, do I have to come up with that money today?
Yeah.
You know, and I said, actually, you don't. If you've got good credit, there's, you know, just go finance it. So
let's get back to that $50,000 truck. 50,000 because it's a round number. Let's just do a little exercise on how you can really accumulate wealth in a hurry. So you invest $50,000 in a vehicle, and let's say you put no money down just to make it easy. And as I said earlier, if you're paying 40% of your income in taxes, you've just created a 40% of the 50,000 deduction. That's 20 grand. So you've acquired a $50,000 vehicle, no money out of your pocket. It's created a $20,000 tax deduction, which means the government is basically giving you $20,000 because you bought it. All right, correct me if I get this wrong. They basically are giving you 20 grand because you would have taken that 20 grand out of your pocket and given it to them.
exactly.
Right?
Yeah.
So it's already made you 20. Now you put the vehicle on the road, and the vehicle should produce maybe $250,000 in revenue. And that would be true with an HVAC company. You're looking at about 700 gross profit dollars per person day. Call it $250,000 a year. So you have $250,000 in revenue. Let's say that's a 10% net profit. That's $25,000. So there's $25,000 more. That's made you $45,000, and that's year number one.
Yes. Yeah.
Do that 5 times.
Yeah.
Every year. And now all of a sudden you're rich, and your family says, the only reason why you're rich is because you're lucky. You're lucky. You're luckier than I am. You're luckier than me. You know, you always had it easy. Always. And I don't know why you can't buy me a car when you've had it so lucky. And it looks like luck when it's the 2%ers, those little bitty
Doing
things.
little things like that. Exactly.
Yep.
Exactly.
Yeah.
We did get another question that came in.
Hey, get what you want to get it live on there? See if I can get my engineer live on here. We can hear his voice. Can you put your mic on?
Well, I need a mic.
Oh, all right. Well, what's
We
the
can
question?
hear you.
What's that question?
Is it better to lease or buy software for my business?
Is it better to lease or buy software for your
I'll
business?
let you take this one. You sell an excellent software package. So
So it's kind of like the vehicle, really. When you have a chance to buy software and own it outright, typically you pay less over time for that software. Assuming that the whole purchase was tax deductible, then you're probably better off when you can to buy software because you pay less and you get the deduction immediately. When you lease software, you under what we call SaaS, software as a service, it's a monthly payment. And after about 18 months, you end up spending way more because it never ends. So in my company, and I don't want to make this about my company, Aptoro, we're a software company, so I'm familiar with this. We have both opportunities for people. You can buy it outright, and we make less money over time than if we were to lease it to you through the SaaS
Okay.
model. But if we lease it to you, we get much less upfront, but we make way more, over time. If you buy it, we get more now. So for a company, if you can buy it, I would buy it without knowing the details. But here's the sad part. Almost nobody is selling software. Ain't nobody selling software anymore. It's
all
really,
lease.
it's hard to find anyone that'll sell you software. I'm sure you guys have noticed it. You go out and buy almost any software now, even like WinZip, where you zip up files and just little things that we used to buy for $49.99 or $19.99 and $500. You could go to the office supply store and get accounting software for $500 and you didn't pay for it again.
Right. Now
Right.
Now they're locking you in.
Everything is a monthly payment. Everything is a lease now.
Yeah.
So it's really getting hard to find software that you can buy and own it and not keep making those payments. Now, I will say, when it's an enterprise level accounting program or business management program, when they sell you the software, you still typically have some expense over time for maintenance and updates, tech support and updates. You pay a little bit, but you pay way less than you'd be paying for the software. I mean, there's software companies right now that are charging like $250 a month per user forever.
So if someone buys Aptora software, sorry, I'm going to turn into a host for a second because
Okay.
I'm curious about this.
Go ahead, Larry King.
If someone buys your software, do they get continuing support or service? Or is that something they would?
Yes, yeah. If
Yeah.
you buy the software, then after you get tech support and you get updates for a year, then after that you pay a small fee, relatively speaking, a small fee to
Okay.
continue to get the support and the updates.
Yeah.
But it's way less than if you were paying the monthly fee per person.
Okay.
Now, here's one problem. By the way, I love the SaaS model as a business owner. I don't like it as a buyer. As selling it, I love it. Buying it, I don't like it. I wish I could buy my software outright because I know it's cheaper over the long run. It's many of you companies out there are spending $1 million in 10 years on software. $1 million.
Wow.
I mean, it's pretty easy when you're spending, say, $225 a month per person, and you've got, say, 15 people, and then you eventually have 20, 25, 30. Someday, hopefully, you'll have 50 people, 100 people. 100 times 225 every month.
Yeah, that adds up.
It adds up.
Yeah.
Yeah. I mean, that's pretty much, you could start thinking about acquiring a software company at that point.
Well, they're more asking what's the tax implications.
Tax implications. Yeah. So if you buy software outright, then the whole thing is tax deductible, assuming you have income and so forth. There's a few rules, but in other words, it's like we were talking about the vehicle.
Software does not fall under the bonus selection, so you would have to amortize that over 15 years. But again, it's going to be a sizable deduction.
Okay.
So if your program costs $100,000, basically, let's say it's $150,000, it'd be $10,000 a year over 15 years.
Okay.
The deductions.
Now, aren't there some rules about software, whether or not you can deduct it fully when you buy it, or you have to amortize it? Aren't there some rules about what the software does or the value of it?
I know that most software is a 3-year. Well, actually, some software is a 3-year life.
Mhm.
So maybe it is a 3-year deduction.
Okay.
Yeah. I'm sorry about that. Yeah. So as if you were to purchase a software package like Aptora, and what is the going package, you'd be able to deduct that over 3 years.
Right. So and the price can vary.
I don't
so
know why
much,
I got
but-
amortization on the brain.
Oh, that's okay. That's all right.
That's 15 years, but
Yeah. So
that's if you maybe created some software and there was some intangible asset involved, then you amortize it over 15 years.
right. Okay. So I think our answer is you buy it outright. You'll depreciate that over 3 years. If you're leasing it, then each lease payment is tax deductible.
Mm-hmm.
Right.
Exactly.
So, okay. And, a lot of these decisions also depend on whether or not you think you're going to make money. I mean, I have created a budget and known I wasn't going to make money this year because I was doing something that cost a lot. And of course, if I'm not projecting a profit, then I'm not thinking about tax deductions as much as I would be if I was making a profit, right? It changes that whole dynamic.
Mm-hmm.
And that's one thing I think is related to the topic tonight is budgeting. It's so important for all of you to start thinking about a budget. I know you want something to do over the holidays when you're not working, right? You're trying to enjoy Christmas and you're looking for something to do a budget. It's so important to do a budget, which is basically a fake income statement, a pro forma, as the nerds call it, right? But it's a fake income statement. It's a fake balance sheet, and hopefully you include a fake cash flow statement. And by fake, tongue-in-cheek, I mean it's your prediction.
Yeah.
And that way you can talk to your financial people and say, based on this, what do you think we should be doing?
Yeah.
Or, gosh, I'm going to lose money. Can you think of anything I should do differently to maybe take advantage of the loss or maybe mitigate the loss? Is there something I can do to mitigate the loss?
Yeah.
But either way, until you have that information, you can't plan for it, right?
Exactly. Yes.
Yeah. All right. Got that question, engineer? All right. Good. Thank you for asking those questions. We really appreciate it. It's fun to get questions.
Where did he get his name, engineer?
Engineer, his mom gave him that.
Oh, wow.
Yeah, she took one look at him and said, engineer. She said he had a face for radio.
I think we got all the bugs worked out. They said we were getting a little bit of audio feedback, which I made some adjustments, and Adam was in there to say good, bad, and we dial it in. So
Engineers probably can't hear his voice. Engineer's telling me he's been working on the audio troubles and making adjustments, and we have somebody out there trying to vector us in to the right adjustments. Thank you. Thanks to Adam out there. All right. So I had a couple of things I wanted to address. Oh, you know what? I wrote a little note here. Basis. I've heard you say basis a couple of times, and I'm not sure everybody understands basis. So tell me, when you say basis, what does that mean? What I'm really interested in is something that you've talked to me about in the past, and that is how many companies don't calculate their basis. They don't have accounting people calculating their basis. What is all that?
Yeah, shareholder basis is kind of like I guess a running tally of skin in the game, if you'll call it. And when you've got no skin in the game, distributions become taxable. When you've got no skin in the game, losses are not able to be taken. You might have to suspend them until you can make that up. That's the easiest way for me to explain it without getting into the computation. But in general, you start with your initial capital contributions, income increases basis, deductions lower the basis, and that's pretty much it. Distributions lower the basis. Non-deductible items, charitables will lower the basis. But yeah, it's a running tally of your skin in the game. And what was your other question on that?
Well, basis, I think, is used in different contexts, but that's the one I was most interested in having you address. I think the point that I wanted to make was, if no one in your company has ever been told about basis, then you have a tax preparer, not an accountant.
Right. And a few years ago, the IRS made it a requirement that if you meet one of 4 criteria, you have to have that basis attached to your return. So if you're reporting any kind of distribution, passing through any kind of loss, taking a shareholder repayment, or there's any transfer of stock, that basis has got to be attached to that return. So whereas 10 years ago, maybe 10-20% of the people understood what basis is, we're starting to see that number grow. People are starting to pay attention, and accounting firms are starting to catch up to getting people's basis calculated properly.
Okay. Yeah, it's important for people to know about that. I always tell owners, you don't have to understand any of this. You just have to have someone that does. it pays to know a little bit so you can ask, Mark, should I be concerned about my basis? Are we going to do section 179 this year? It helps to know a little bit.
Yeah.
But really, you just want to get you a mark and have them worry about it. Let him be the nerd.
I tell a lot of clients to focus on what they do well, go out and make money, check in with me on the quarters, and let me handle my end. And most of them really got a grasp around the basics. And they understand the concept of basis, and they understand that without skin in the game, there's no way to take a distribution without getting taxed. It sneaks up, but again, going back to what happened with the PPP, we got the triple bonus because we got that boost from the PPP forgiven loan. So.
If you're enjoying this, by the way, please take a minute to hit the subscribe button and the little bell for notifications. It really helps us more than you could know. It impresses the YouTube gods, their algorithm, so please do that if you're enjoying this. I think basis is one of those things that I always found very complicated. I saw the computations. They were freaky, and I was happy that you understood it, and I wasn't going to learn it.
I bring it up at cocktail parties and everyone walks away.
Yeah.
I find it fascinating, but other people don't.
How can a contractor, this question came into me, how can a contractor increase the value of their business? And I wanted to take a minute to address that. Remember, if your company's worth a lot of money, then you're probably going to sell to somebody that's got a lot of money. All right? Poor people aren't going to be looking to buy your business. It's going to be a rich person. And what's a rich person want? They don't want your 8-foot brake, your Pittsburgh Seamer. They don't care about your tools, your ladders, your trucks. They could go out and buy all of that and have fun doing it. Probably buy better stuff than you've got. What they care about is recurring revenue. Recurring revenue. So that would be money that's coming in with very little effort. So rather than going out and running a service call, which takes a lot of effort, or doing an installation, you have money coming in on a monthly basis, recurring revenue. That would be service agreements. So increase the value of your company with service agreements. The more service agreements you sell, the more valuable your company is, the more desirable it is to a buyer. A buyer might give you, if you can believe this, 15, 18 times earning on, or revenue rather, revenue, just income, 15 to 18 times for service agreement money, and maybe 2 or 3 times for all the other money. Wow. That's it. That's all. So service agreements are where it's at. That's how you're going to increase the value of your company. The second best thing you can do is think of your company as a franchise. Systems, procedures, policies, rules for everything. The more you solidify the way your company does things, the more they'll pay for that company. Make sure that you have trademarked your name. Make sure that you've protected your logo, things like that. They'll pay more for that as well. But they really care about the service agreements because it takes time to build those service agreements. Now, with that in mind, how can a company get some idea as to what their value is? There's a lot of valuation methods out there. What do you recommend somebody look into if they're trying to figure out what their company might be worth?
Definitely get with someone who's ABV certified. Valuations can be tricky depending on the person that's basically paying for the valuation. You could get. I've had a couple that have come from opposing sides that were $13 million apart.
Wow!
So valuations, it's not a science. It's in an art, and there's a lot of assumptions that go into it. The discounted cash flow method is good. Looking at comparable companies with similar revenue, a lot goes into a good valuation. So I would suggest seeking a good firm that has ABV certified professionals.
Okay, that's good to know. You're right. It can be very subjective, not objective, right? I guess it all depends on your company's worth, what someone will pay for it. But a good a good appraiser is going to know what people are paying for companies, right?
Exactly.
Okay, good. Do we have any other questions, Mr. Controller, that we haven't addressed?
No, questions-wise, we're good.
All right. Mark, was there anything that you wanted to add?
No, I thank you for having me in on your first kickoff of this event. I'm just honored to be here.
It was
Thanks for having
awesome.
me.
I appreciate you being here with
Yeah.
me. And I want to really tell you how much I appreciate all of you who hung in there with us, came here and watched the video. And of course, this will become a recording. So hopefully we'll have lots of people watch the recording later. Doing it live, we could just do this not live, right? But it's fun to do it live rather than record it and have somebody clean it all up and make it
Yeah.
look perfect.
Where's
I'd
the
rather
fun in
just,
that?
I'd rather do it live. Yeah. So we'll get out of here and see if we can watch the end of the football game.
There you go. Go Chiefs.
All right.
Make sure you have them tell their friends about the show because we're covering different topics. It's youtube.com/.
Oh, yes.
Service Live.
Yeah, the engineer, Mr. Engineer's telling me what I should have thought of. YouTube.com/Field Service Live. Tell your friends about it. Ask them to subscribe. It'll really help us out. We would like this to be a long-term thing, and we really would like to get traction and help a lot of contracting companies. So please spread the word. Again, I'm James Leichter for Field Service Live. Thanking Mark. I hope to see you all again. Good night. Thank you.
Thank you. Thanks for bearing with me.
Yeah.